I have noticed that a lot of my YouTube subscribers still have some confusion regarding how to properly keep a stop loss. So I want to explain that in this video. I am talking about trade execution. I am not talking about the selecting the buy point or selecting the stop loss level. I am talking about the type of order to put and what to put in that order. Okay. Because trade execution is a very important skill to learn. You need to learn three skills: stock selection, trade execution, trade management. And those of you who want to do trade journaling, you better assess how you are doing in terms of these three skills. Okay, stock selection, trade execution, trade management. There is no point in counting chickens. There is no point in counting your profits and your losses. You have to go back to the trades that you took 1 month ago, 2 months ago, 3 months ago. And at that time, you have to check, was your stock selection correct at that time? Was your trade execution okay? Did you manage the trade correctly? So stock selection, trade execution, trade management. So let me draw a base. This is about trade execution. So let's draw a base. Okay. So let's say this is a base. I will draw it again. Yeah. So this is the base. Okay. Now see, this is the buy point, point 1, point 2, point 3, point 4, point 5, point 6. So let's say this is the buy point. So I will draw a line here. I will press Alt H. Okay. So that's the buy point. And let's say I want to keep my stop loss at say 8%. So let's say it's here. Okay. I will keep the stop loss at 8%, which is the low of the latest candle. Let's assume it's 8%. Okay. Just to keep things simple. Generally, it is not 8%, but or let's keep it practical. Let's say it is like this, but I have kept my stop loss at 8%. So let's say this price is 100. Okay. This is 100. And let's say this price is what? What should be that price? It should be 8% below 100. That means it is 92. Correct? So this is 100. Let's say you want to buy a stock at 100 rupees. See, ignore this price. Okay. It is just an example. I'm just using this as a chart. This is a blank canvas to draw the base for you. Ignore all of this. So let's say 100 rupees is the price at which you want to buy the stock. 92 rupees is your 8% stop loss. How will you put this order in your broker? You do something called as a GTT order. Okay, good till triggered. So this requires one trigger price. So trigger price. Now what's the trigger price? Trigger price should be your stop loss. So 92 is your trigger price. What does trigger price mean? Trigger price simply means that let's say the stock goes up from here, touches 100. So you buy the stock, let's say volume is high, and then it starts to fall. When it starts to fall, if it touches 92 level, the order gets triggered. So GTT is a order. Okay, GTT order gets triggered. When the price touches 92, the order gets triggered. Triggered means what? See, when you place a GTT order, that order goes to your broker. Okay, that order is there with the broker till it is triggered. So now, when the price touches 92, that order gets triggered and that order goes to the exchange. Till the time the price is hit, nothing happens. Okay, the order remains with the broker. But the moment it touches 92, that order is going to go to the stock exchange. Now, when you place an order with the stock exchange, what does the stock exchange want? The stock exchange just want two things. At what price are you willing to sell, and what quantity are you willing to sell? Okay. So let's say the quantity is maybe 335 shares. Okay. So let's say quantity is equal to 335 shares approximately. Okay. Just a random number. And the limit price. Okay. This is called as the limit price. Now, the question is, what should be the limit price? See, the exchange wants only two things, the quantity and the price. Okay. So let's say we put limit price as 92. What does that mean? Okay. What does this 92 mean? 92 means I am willing to sell the stock at a price which is at least 92. Okay. Let me repeat that. First, the price goes up, hits my 100 buy point. I buy the stock, I see good volume, I see good setup, but then it starts to reverse. Maybe the market conditions have weakened. It starts to reverse and the price hits 92. Okay, the moment it hits 92, which is the trigger, this order, like this order, goes to the exchange. Who sends that order to the exchange? Your broker sends that order to the exchange. Okay, now the exchange is only wants two things, quantity and price. Quantity we have written 335 shares. Okay, price 92. 92 means what? 92 means I am telling the exchange that I want to sell 335 shares, okay, which I have, which I bought here. I want to sell 335 shares at 92 or higher. Like the minimum price at which I am willing to sell is 92 or higher. I don't want to sell below 92. Okay, that is what this order means. That is why it is called limit price. There is a limit. Okay, if it's below 92, I'm not willing to sell. I want to sell at 92 or higher. Now, there is a problem with this order. Let's say the price hits 92 and it gets triggered. Okay. Now, when it gets triggered, this order is going to the exchange. So the time that it takes for the order to go from the broker to the exchange, it could be very less. It could be just seconds or microseconds. But the time during which the order goes from your broker to your exchange, during that time, if the price suddenly drops by, like, one tick or below 92, or maybe it falls to 91 quickly, okay, very fast, then there is a problem. Let's say the price drops to 91 before it reaches the exchange. Will this order get executed? No, because you already told the exchange that the minimum price that you want for selling your shares is 92 or higher. Anything above 92 is better, but you want minimum 92. But when the order reaches the exchange, right, the price is 91. So will your stock get sold? No. Why will it not get sold? Because if the market price at that time, when your order reaches the exchange, if the market price at that time is 91, I mean, if people can buy the stock at 91, why will they buy the stock from you at 92 rupees? The stock is already available at 91 rupees or maybe 90 rupees. Why will they pay you 92 rupees? So that is why your order will not get executed. The order will remain in the exchange. So in case if the price rises further, comes to 92, your order will get executed, but the order will remain in the exchange. And I think in the exchange, the order expires when the day closes, the order expires. Correct? So this GTT order, it's got unlimited time frame. It can remain with the broker for unlimited period of time. I think unlimited means the period is around 1 year. You can check the details, but it is good till triggered, right? But this order is not unlimited. This has a time limit on it. Maybe after the day closes, the order will get expired. Maybe it's a 1 day time period order. So how do we solve this problem? How do we solve this problem? So the simplest way is just keep the limit price 2 rupees below, just keep it 90. It's very simple. So that means you are saying that you will sell the stock at 90 or higher. Now you might say, Rohit, why are you changing the stop loss level from 8% to 10%, right? Well, you have not understood this yet. Okay. See, when the price gets triggered, At that instant, let's say your order goes to the exchange. Okay. At that instant, what's the price? 92. What's your limit price? 90. Will this order get executed? Of course, it will get executed because you're telling the exchange that I am willing to sell the stock for 90 rupees or more. And the moment the order reaches the exchange, in most cases, the price is going to be 92 or near about 92, maybe 91.95 or something like that. Okay. But it will be very close to 92. So the instant at which the price reaches the exchange, obviously it is going to be above 90 in most cases. Okay. Sometimes the price fall is so sharp. Sometimes this order also might not get executed, but 2 rupees or 3 rupees is a decent amount of price that we are putting to get that order executed. So if I put limit price as 90, I am telling the exchange that boss, the moment it gets triggered at 92, I want to sell my stock at 90 or higher. So even if the price drops below 92, even if it comes to 91.80, my order will get triggered because it is still higher than 90 rupees, right? So that slippage, the price went from 92 to 91.8. So that 0.20 is nothing but the slippage. My real stop loss is not 8%, it is 8 point something percent, right? But that's okay, that's tolerable, right? But if the order doesn't get executed, that's a big problem, right? Because if you put this 92, okay, and by the time the order reaches the exchange, let's say the price is 91.95. So it is just 0.05 rupees below the your selling price, right? So the order will not get executed. That's a huge risk. And the order will remain with the exchange. And let's say it continues to fall, it goes from 91.95 to 91, then 90, then 84, then 80. Your order will never get executed, right? Because you told the exchange that your minimum selling price should be 92 or higher than 92, whatever is better than 92. Correct? So please understand that when you put GTT order, you have to be crystal clear in your mind what that order means, how the execution takes place, what is the trigger price, what is the limit price, what does the quantity represent. Now, quantity, okay, quantity is the number of shares that you want to sell. Okay, so let's say the price goes up from here. Okay, let me give an example. Let's say the price goes up from here. Okay, let's say it goes to maybe, let's write it 120. Okay, and you want to keep the, sorry, let's say it goes to 120. Okay, just approximately I'm saying. Now you want to keep this to 115. See, now your stop loss is above your buy price, which means what? Which means you're trying to protect your unrealized gain. So let's say this level is 115. So we'll move the stop loss from 92 to 115. What happened? Yeah, 115. Okay, now tell me your trigger price. Yeah, your trigger price is 115. Your limit price, what should be your limit price? Limit price, let's say, let's keep it 2 rupees below 113, right? See, now trigger price. So let's say the price starts to drop from 120. Okay, it goes to 115. So 115, the order gets triggered. This order goes to the exchange. You want to sell 335 shares at 113 or more. Now, at the time the order reaches the exchange, what's the price? 115 or very, very close to 115, which is higher than 113. That means your order will get triggered, right? Because you are telling the exchange that boss, please sell the stock at 113 or higher, whichever is better, whichever is higher. Correct? Now, in this case, the quantity becomes very important. Let's say you have got 335 shares. Okay, you buy here 335 shares. It is not necessary that you have to put the quantity here as 335. You could keep here quantity as maybe, let's say, 200 shares. This is called partial selling. Simple. So it will sell only 200 shares. Okay, it will not sell all 335 shares, which means out of 335 shares, you sold 200. So remaining 135 shares, what happens to that? Well, for that, you have to keep another GTT order. What's that GTT order? You will move the stop loss to break even here at 100, correct? You will move the stop loss to break even. So at that, for those remaining 135 shares, what will be your order? Your order will be, your trigger price is what? 100, because that's where you kept your stop loss, right? It's at break even. What's the quantity? You have the remaining 135 shares. So you have 135. And what's the price? Let's keep it 98 rupees. So if it hits the trigger price, I want to sell it at 98 or more. So very simple. So now you understood how to keep a stop loss at 8%. What should be the trigger price? What should be the quantity and the limit price? This is a GTT sell order. This can be used to keep 8% stop loss, 8%, whatever percent you want to put. The difference will be the price. You can use it for stop loss, you can use it for partial selling. So your order gets automatically executed. You don't have to be in front of the chart. So use the GTT sell order for two purposes. One is to get out at a specific price properly, and one is to get out after the stock has gone up. One is to protect your capital and unrealized gain. You could choose to sell all shares, but you could also choose to do partial selling. Or you could do multiple GTT orders, like one sell order will be here at 115, maybe 200 shares. Then at 110, you would sell another 50 shares. Then at 105, you want to sell another 100 shares. So you could keep three GTT orders. It's just the quantity that will change, right? And you know how to put the quantity and limit price now. That is how you use the GTT sell order. Okay, so that you don't have to sit in front of the chart wondering what is happening. This is especially helpful if you are working at a 9 to 5 job, you cannot watch the stock and things like that. So, this is a very good feature, and most brokers, I think, in India are offering this good till triggered order. So, use this effectively. If you have more doubts on this, please let me know in the comment section. We will do more discussion on this. Okay.